Hello, my name is Dan Brownell. I'm a senior underwriting consultant in the Chicago office of Munich Re. Thank you for joining me today for a brief overview of one of the four basic elements of financial statements, the balance sheet. Since we often see balance sheets and other financial statements in association with business coverage, we'll be looking at the balance sheet from a business perspective. A balance sheet shows a company's financial position at a specific date, a snapshot, if you will, normally of the closing date of the company's financial year. It lists assets, what the company owes and what is owed to the company, and liabilities, or what the company owes. It then shows the book value, also known as equity or shareholders' equity, which would be the excess of the company's assets over its liabilities. The balance sheet thereby takes its form from this basic accounting equation: assets equal liabilities plus owner's equity. Regarding the book value, in the course of underwriting you'll often run across reference to the market value of a business, which may be used to justify the amount of business coverage being applied for. It should be noted that the market value, which is essentially what the business is worth if it were sold, is very different than the book value. The market value is generally some factor of the book value and will depend on many other factors, including the type of business and how well the business is performing. The results from the income statement, another of the four basic financial statements, also feed into the balance sheet. After the income statement is prepared, the net income is transferred to the equity account on the balance sheet. The assets and liabilities on a balance sheet are listed in order of maturity, with the current assets at the top and the fixed assets at the bottom. Current liabilities are at the top of the liability side of the balance sheet, with owner's equity at the bottom. A company's assets can include cash, marketable securities as in stocks, bonds, etc., receivables, inventories, and prepaid expenses. Fixed assets can include land, buildings, machinery, tools, and equipment. They're listed on the balance sheet at original cost and, with the exception of land, are depreciated annually. A business's current liabilities include all debts which must be paid within the next 12 months, such as raw materials costs, wages and salaries, loan interest, legal fees, and taxes. When reviewing a balance sheet from an underwriter's perspective, there are a number of different things you'll want to watch for and keep in mind. You'll want to compare different financial periods for trends. After verifying what dates are being covered, look for significant changes, positive and negative. Watch for changes in auditors or the type of accounting procedure being used, which could be a clue for underwriters. Add depreciation and amortization back to net income. This can help you in justifying the coverage applied and provides a more accurate financial picture. Verify if the statement you're reviewing is audited or unaudited. Whether it's a compilation report, a review, or an audit report, all are helpful, but an audit report is the gold standard. And very important, read the notes included in the financials. These can be a great help in explaining the background and significance of the entries you're reviewing. And most important of all, does it make sense? In the end, you want to document that the amount and type of coverage you're underwriting is reasonable and financially justified. Thank you for your time today. We would love to hear from you. Please send questions or feedback to us at the email on the screen.